Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading. What I'd like to do for you is just recap some of the weekly moves which we saw across the board, how things are setting up moving into next week's worth of trading. We did see some advancements in terms of, I guess in many ways, material sort of breakdowns taking place across the board in the markets, especially on Thursday's trading session, really just continuing off from that narrative, that video I posted on Wednesday evening as we transitioned into trading on Thursday. We are at a critical juncture point right now on the financial markets. You need to be made well aware of it. We are at what we call a pivot point, a turning point in the market. And again, whether or not we turn up and this is some form of a successful backtest off from the recent breakout which we established in July, time will tell. Otherwise, we are going to see an intermediate pullback, most likely an intermediate correction, which is going to take us down on the Dow Jones Industrial Average at a minimum down to roughly 17,500, but really, I guess more ideally in terms of a good correction, a healthy correction, down to around 17,000. That is about 1,140 points from where we are currently trading at on the Dow Jones Industrial Average. It is, again, relative to the S&P 500. You can see this advanced sort of trend line coming up through here. We are definitively breaking down from that trend line, or at least it appears to be that way. We may see some form of a back test, which may play out this week. I'll speak a little bit more about that. But again, this particular market address, dated Saturday the 15th of October, again mid-afternoon here local time, it is going to continue off from, again, that Bollinger Band squeeze which I referenced on Wednesday evening as we transition into the pre-market on Thursday morning. So really just, I guess, in many ways to continue. What I left out last week again was this, I guess, aggressive trend line. Now, when we speak about trend lines, we can really go back and sort of reference some since the 2009 lows. They work, or what their real name is, fan lines. And if you're looking at bullish fan lines, they are called decelerating fan lines because as the trend continues, the slope or the trend trajectory decelerates. It becomes weaker, weaker, and weaker until inevitably, generally around the third or fourth fan line, the market itself is moving sideways. And if you think about it, really since late 2014 into the beginning of 2015, this market is relatively unchanged. Yes, we are recovering a lot of the losses, obviously all of the losses since the beginning of 2016. But to put that in perspective, just look at where we were around mid-2015. We're right back at that same level. So the market itself has been relatively stagnant within this major primary uptrend. This is the fourth decelerating fan line on the Dow Jones Industrial Average. That is the fourth fan line since the 2009 low, and most recently since January, February, where we saw the last waterfall sell-off. Let me just zoom out another fractal so you can see this. We have had this aggressive trend line which has continued. You can see the beginning of the fan line here, or the trend line, the intermediate trend line here in February. You can see again that first higher low in late June, and it has continued right through to September and October 2016. Fast forward to Tuesday, where the market broke down on pretty decent volume. You can see this long day type of Morobozu candlestick, and again, it had a lot of people sort of worried as to whether or not this was going to, I guess, turn into a bigger type of move. Now, although those, I guess, scares, or at least that anxiety, has formally been pushed to the side given Thursday's trading session activity, Friday's trading activity, right after that intraday reversal around that 17,970 area. Of course, we didn't close below it, nor did we see a continuation. During Friday's trading session, this was looking like a quite healthy candlestick. It was a long day, white day candle. However, towards the end of trading, really from mid-morning through to the close on Friday, we saw a slow and gradual sell-off, and it has left us with what we call a shooting star candlestick. Now, oftentimes prior to a sell-off, now again, we are approaching the week upcoming relatively neutral, given that we are still range-bound during this stagnant sideways move. It does lead to eventually or inevitably some form of a correction. Now, I'm not going out and calling this some form of a primary trend reversal. You need to keep, again, these trends in perspective. This is zooming back out onto the weekly chart as the markets were putting in lower lows and, of course, macro lower highs. We established this fourth trend line, very rare in terms of Dow theory, but it is to be held accountable. It is to be proven true, or it is true until proven guilty. We are positive, i.e., long-term macro bullish as long as we remain above this level. But considering that this intermediate bullish trend has or appears to be definitively breaking down, it gives us a really nice target moving forward. So we can sit here and say, as market technicians. If in fact this is just the beginning of the move, this is the first sort of intraday crack of this critical support area at 17,970. I can show you some examples in the past across market indices where this type of trading activity or behavior takes place prior to a bigger move. Well, then we're looking at some considerable downside action. Now, to put this in perspective, yes, we have been setting up structural support. And again, it is still largely undecided, and there is a lot of, I guess, bifurcation in the market, a lot of uncertainty in terms of direction. We are at a pivot point. We can bounce, and I want to make that and stress that to be abundantly clear. We may just turn up from this point and continue this from 18,138, but it's looking as though we are seeing, again, some technical signals which are alerting us that, hey, we are looking forward, or at least on the horizon, the near-term sort of precipice, we may be seeing, again, some contraction, or at least a pullback, a healthy pullback in price. The first one alerting us are these exponential moving averages. You see how the slope, since breaking out in July, it has been healthy. We can see the 10 above the 20 above the 50, and price above both. Well, as this trend breakout has failed to gain traction, as the bullish trend has failed to continue, the exponential moving averages are sideways, they are flat, they are horizontal. In fact, since September, when we broke down on that Friday, we have tried to overcome the 50 and hold on 1 occasion, 2 occasions, 3 occasions, 4 occasions, 5 occasions. That is throughout mid-September through to the breakdown right up until this week's trading activity. As you can see, we've pushed below the 10, the 20, and the 50. In fact, on Friday, we've come up. We tried to hold above the 10. We failed. We tried to push on up above the 20. We failed. In fact, we got more or less to a point intraday touch on that 50 EMA, and we turned down. That is why we have this particular candlestick, that shooting star candlestick, which is showing up at the back test of this aggressive intermediate trend line. On top of that, if we start looking at the simple moving averages, it seems as though recently we've been holding on that 100 simple moving average. However, since breaking down on Tuesday, we are starting to retest this from the bottom. And as you can see again on Friday, sellers lurking at that 100 simple moving average. If we look at oscillators, right, to show us, well, are we overbought, oversold? Are we moving sideways? How do we actually apply these to the market? We are pretty flat. They're relatively neutral. You can see the Stokes here right in the middle of the buy and sell zone, at least the overbought, oversold type of reading that the stochastic produces. You can see the RSI, again, very neutral, 44 print, 44.62, very close to 50. And the MACD, although it is technically bearish, it is relatively flat. So I mean, we're not really learning a lot from these oscillators other than what the exponential moving averages are telling us, which is, hey, the market isn't trending, it's moving sideways, and because of that, we should remain neutral. What we've tried to do, and looking at price and looking at structure and combining candlesticks and trend lines, is that we're finding infliction points. We are finding pivot points. We are finding areas on the chart, macro pivot points, turning points, where the consensus of traders, or active market participants, investors, are going to have to collectively decide whether this market wants to continue up off from this support area, which we are currently holding, or whether or not this is going to be some form and usher in more so of an intermediate correction back down into that fourth trend line. That is what is up for debate right now in, I guess, the realm of technical analysis. Price hasn't confirmed one direction or another. And as technicians, we're sitting here, we're looking at the analysis, we're looking at, I guess, advancements, continuations in price action, and I'm bringing you this information, you know, as at on Saturday, the close of the week's trading, just to update you on some of these advancements which are taking place. You can see again, the exponential moving average is flat. We've broken down below them. We've tried to overcome the 10, the 20, and the 50 on multiple occasions. I'm just relaying this information to you. We have failed on every occasion. Again, on Friday, shooting star candlestick at those exponential moving averages. However, they are moving flat, so they're telling us that we are in a trendless state. If you apply the long-term simple moving averages, yes, of course, on the Dow and the S&P and the NASDAQ, we are holding above the 200, but of course, before we can get to the 200, we need to break below the 100. Well, what has happened? The 100 has been acting as support. We've cracked below it. Thursday, again, we started to intraday push below the critical area. Yeah, no, we didn't close. We didn't continue from that close, so it was only an intraday push. But again, we've come back up and we've closed more or less. Well, we closed below the 100, but we opened at that 100 SMA. We pushed up intraday, but we failed and we pushed on back down below it. So some interesting advancements again taking place on the S&P 500. When I change to the NASDAQ, okay, it is a little bit of a different picture. We are healthy. We are constructively healthy. We are above the 100 and the 200. But what is very important to pick out again is since the breakout in July where the exponentials have been healthy, they have been supporting price, they are flat, they're moving sideways. In fact, price is now crossing and closing below the 50-day EMA, and the 10 has crossed below the 20. If you want to take the slope of these exponential moving averages, they were healthy as if they were pushing up towards 1, maybe 2 o'clock on a clock, right? That's what you want to see during a bullish trend. However, they have flatlined. They are moving sideways. They are horizontal. They are telling us that the trend is slowing. On top of that, we've got the three markets not in agreement. As the NASDAQ was pushing up and making its respective all-time high, the Dow Jones Industrial Average and the S&P 500 had pulled back quite a distance from that very same point. So we're seeing that the markets are not in agreement either, hence why this is dotted to say, hey, it isn't confirmed on the move intra-market or on an intra-market basis. It is not confirmed. And as you can see, we've got an evening star reversal pattern here on the NASDAQ, and we are pulling back. This doesn't usher in a reversal. In fact, oftentimes you need to see price consolidate and build structure around the 50, and to see that 50 begin to turn down until you see an intermediate healthy contraction or pullback in the market back down into those macro buying support areas. When we look at the NASDAQ, the healthiest of the three markets, you can see significant divergence. This is on the daily time frame. See the Stokes? See the RSI? You see the MACD? This is all what you call bearish divergence, or otherwise known as negative divergence. It isn't a good thing for a market, and especially you don't want to be seeing divergence when markets are breaking out very freshly or newly to their respective all-time highs. So this is some major warning signals. Whether or not you want to heed it, whether or not you want to notice it, that's fine. You can, it seems as though a lot of people, at least the consensus is very complacent at the moment, head in the sand, everything's okay. This is just a routine, normal pullback. This is a back test. This is constructive, and we are going to see a bounce. But a lot of these indicators simply aren't really confirming that whatsoever. In fact, they're starting to skew negative, or at least side towards the bearish pullback type of move on the intermediate time frame back down into the primary long-term trend of the markets. Very rarely do you see a fourth fan line. On the NASDAQ and the S&P 500, we are still holding above the third fan line, but the Dow has definitively given us a fourth fan line, which is very, very interesting as well. On top of that, I think I touched on this prior to Thursday morning's update. You can see this divergence taking place on the monthly time frame. Go back in time and point out to me when markets have given us monthly divergence on the MACD, even on the RSI or the stochastics. I mean, it hasn't even shown up in other reversal periods prior to most recently the 2007 top, and also going back to the turn of the millennium. It just didn't show up either. It did show up, however, on the weekly time frames, but given this 1.5 year sort of sidestep, a lot of this weekly divergence, which we have been speaking about for months, it's broken down with this recent push to the upside. But what it has developed is just a greater fractal of divergence, where we're stepping up from the weekly to the monthly. But then again, if we drill back down to the daily divergence on the NASDAQ, it is very prominent and it's there as well. So I mean, there are there's a lot of red flags on this move. Even if I start picking up, bringing up the ADX and the CCI, look at the CCI. It's not above 100. It's not trending. It's saying it's not healthy. This isn't good. When you see this on an individual stock, which appears to be breaking out or on the precipice of breaking out, it's a major warning signal. Look at it on the NASDAQ. It's below 100. If you look at the Dow Jones, in fact, actually, if you look at the NASDAQ, the ADX has turned up during this pullback. Look at that definitive turn up from that resting period around 20. Very, very interesting. If you look at the Dow Jones Industrial Average, we cracked the 100 line back in August. What's happened since August? We haven't seen any material commitment to the upside. In fact, we've just been moving sideways as the CCI comes back down into a neutral standing. It's not what you want to see with the market up at all-time highs. Again, the pullback, ADX is elevated. CCI definitively cracking the positive 100 sign, again on the S&P 500, around that 100 reading in mid to late August 2016 as well. So again, as I sit down and bring you this information, when I speak about fan lines, okay, when I speak about the long-term trend of the market, if I'm referencing, fan line number 1 or 2 or 3 or 4, whether it is on the S&P, the Dow Jones Industrial Average, you need to understand Dow theory. You need to understand how these tides or the current of these different trends on different fractals work together. Now, it's healthy to have a constructive pullback. It shouldn't be scary. You should embrace it. It's healthy for a market. The time, or at least the place on a chart where you need to become concerned, is if this primary trend breaks, which through to the current juncture, even through to 2015, it never did. It got very close to, we were on the precipice of doing it on a number of occasions. This is the weekly chart, but we held and we continued off from this location. This is that same line projected out into the future on the Dow. This is the same line projected out into the future on the S&P 500. All right, so there's a long way to get down before things are really going to get shaky. And if anything, any pullback which stems from this location should be held constructively, i.e. potentially a buying opportunity at these lower areas, or at least to capitalize on either short selling or buying puts on individual stocks, or even market exposure, whether you want to trade the Qs, the SPYs, the diamonds, it doesn't really matter. But just to understand what your profile is as a trader. Are you an intraday trader? Are you a swing trader? Are you a long-term buy and hold, investor? I mean, profile yourself and then just do what it is you want to do, or what fits your profile, most importantly, because what I'm speaking about right now is swing trading, positions which I want to hold for a number of days up until a number of weeks and exit them for a profit. All right. And a lot of what we do has to do with working between different fractals, most importantly, the intermediate and the minor level. Understanding well what direction is the intermediate trend, how does that align with the primary trend, and then where is the opportunity with the minor level of the trend in conjunction with that intermediate trend as well. So it's quite fascinating when you start breaking markets down with fractals. But again, this is very important. This is very telling. What's going on with the Dow, what's going on with the S&P 500. It doesn't necessarily have to reverse. Again, we wait for price confirmation. We want to see price hold, close, and continue below certain areas. I think Thursday is the beginning of something greater, which is soon going to happen. And again, just to show you this, I said I would show you this. And again, it doesn't matter what market I apply it to, but just for argument's sake, how you get these little tentative moves, intraday pushes, and then you get these pushbacks back into the trading range. Have a look at November, December 2015. We established a neckline. We had one here. We had a second one here. Third one here before we got the waterfall sell-off. Go back before that. Have a look at this. This was going through the stagflation, in the market, the sideways move which we were seeing when we saw the break here, a little jump back up, a failure, another jump back up, a failure, a couple more here, until decisively the market said, nope, that's enough. We need that intermediate pullback back into the primary trend, which really rattled a lot of people. It repeats. Technical analysis repeats. It really is it's based on really psychology, emotion of people, and certain infliction points on a chart. If people have been buying long up here and then you start to crack below a certain area, roughly give or take a few points, the people who bought long are going to have to sell, or what they will do is generally that they are, led by their emotions. Fear, panic leads to selling. It's just a cycle. And then once those people are out, then the buying opportunity occurs, or at least happens at lower levels. All right, so learn a little bit about technical analysis anyway if you are fascinated, if you are interested about it, because right now there is a lot of opportunity. That pressure cooker, which I was talking about pre-market Thursday, it is still in effect. A lot of people will say, hey, this was a false Bollinger Band whipsaw. You have to put it in context of what's going on. Yes, it does sort of look like that, but look, definitively we haven't pushed on up, and we certainly aren't pushing up above some of these ranges. The same is true for the S&P 500. I think this is the beginning of something greater, which may happen this week, it may happen in 2 weeks, it may happen in 3 weeks. But for me to get bullish on this market right here, I want to see markets in agreement. And what that means is collectively across the board, the Dow, the S&P, the NASDAQ, they have to be moving in agreement. They have to be pushing and printing fresh new highs simultaneously together. They have to confirm one another. Until that happens, something is wrong, something isn't right. And I guess a lot of these divergences which we're seeing between the industrials and the transportational average, and of course, and also if you're talking about market breadth, with the number of stocks percentage-wise trading below their 50 EMA, I think it's above 70 at the current juncture, and the divergence between that print versus the transportational average and the industrial average, it really is, again, some major warning signals for people who are looking at this and saying, hey, maybe I'll just buy a couple of stocks here, maybe I'll just, open up some exposure long for the market. You may be doing that at, the worst possible time. So I really don't want to go on any further into that. I've just spoken for an hour and a half in pro this week. If you're interested, have a look at that class. If not, that's all right. Have an enjoyable weekend. I certainly will. And I'll see you back during the week for some more, talk on the markets, the state of the markets, and what's developing and what we're looking for moving forward in terms of market action and momentum. All right. So All the best to everyone right around the world. It is James signing off on behalf of Pivot Point Trading. Have a fantastic weekend. Goodbye.